Okay, I thought we would do some problems for Chapter 8. There have been a few questions on the homework, so just kind of want to go over a few of these. Okay, so we're figuring out the total acquisition cost of the equipment, what we're going to include on the balance sheet. So let's go ahead and figure this out. So we paid $60,000, but we get a 2% discount if we pay within the first 30 days, which we did. So we actually paid $58,500. Oops, sorry about that. Freight costs are $1,000, and those are included. So that's part of our acquisition costs. The state agency required that pollution control be installed at 2,500. That's required. I'm going to go ahead and include that. During the installation, the equipment was damaged. I'm not going to include that. That is an expense. So that's just going to be a repair expense that I'm going to put on my income statement. Architect fees of $6,100 were paid to redesign the space. Okay, so the $6,100, I'm going to go ahead and include that. Purchase liability insurance to cover asset for a 3-year insurance policy. That's going to go under insurance expense. I'm not going to include that in the acquisition cost. And then we had interest with the loan. That's going to be interest expense. I'm not going to include that with the cost. So the cost of the acquisition cost is $68,400 here. Okay, let's go on to number 2. So here we're talking about buying an asset, depreciating it, and then selling it and determining what happens here. So we bought an asset January of 2015. We're using a straight line depreciation. So we're going to take the cost of $60,000. We're going to subtract the residual value of $6,000, and then we're going to divide it by the useful life, which is 6 years, and that's how much we're going to depreciate per year. So after it looks like 2.5 years, we received this much in cash and this much in a note. So we're going to add those together, and that's going to be the selling price. So let's see how much it should have been depreciated. So we have $60,000 minus our $6,000 residual value divided by the useful life, which is 6. So we should be depreciating at $9,000 per year. So in 2015, we would subtract $9,000. In 2016, we would subtract $9,000. And then 2017, we would subtract half of that. So we would subtract $4,500. So I'm going to do $60,000 minus 9 minus 9 minus $4,500. So the price at this point, July 1st of 2017, our book value rather, is $37,500. Well, we received $17,500 plus we received $12,500. So we're still sort of, we still have a loss of $7,500 here because between the cash and the note that we received, it's still $7,500 less than what our book value is. So let's go ahead and talk about how this affects the accounting equation. So initially, when we're talking about depreciation, we make an entry to accumulated depreciation for our annual depreciation. This, of course, is going to be $4,500. It might be a negative since it lowers our assets. And then we're going to take our $4,500 in depreciation expense. $4,500. Okay, so that's what we would make just for 2017. 2015 and 16, it would be the full $9,000, but we're selling it in the middle of the year. And then when we actually sell the asset, we're going to get rid of the asset. So, well, let's talk about, we received our cash. Our cash went up by $1,750. Or $17,500 rather. And then we have a note receivable, and that was $12,500. We are getting rid of our asset. What we're going to do is we're going to take the full cost of the asset. We have to write it off. Remember, the asset of $60,000 never changes. However, we are also going to get rid of our accumulated depreciation, which would be the 9,000, 9,000, and 4,500. So 22,500. Again, this might be a negative. And then, so we've taken care of the cash, we've taken care of the notes receivable, we've written off the asset. I think this is going to be a negative since we're getting rid of that. And we are getting rid of our accumulated depreciation. And then, and this is actually probably not going to be a negative since it's increasing our assets. And then we're actually going to have a loss here on the sale of our asset, which is going to be the difference between our book value and what we sold it for. I think we said that was 7,500, and that may probably be a negative on here. So that's going to decrease our net income by that amount. So that's going to be basically what happens with the sale of an asset here. Okay, and one of the last things I wanted to go over was the double declining method of depreciation. This can be a little bit confusing. So what I want to do is I want to pull up Excel. And I think it's easier to do it on Excel so you can kind of see how it all works. Okay. All right. So in this case, we have a forklift that was 6,000. It's expected to last 5 years and have a residual value of 6,000. We use the double declining method for depreciation. So the thing is that we are not going to take into consideration the residual value just yet. All right. What we need to do is figure out how much we're depreciating per year, and then we're going to get to that residual value. So it's expected to last for 5 years. So if it's expected to last for 5 years, we can sort of assume that we're depreciating at 20% per year, because if we depreciate at 20% per year for 5 years, that equals 100%. Okay, so that's using the straight line method. Well, we're going to double that percentage. So if we're doing in straight line 20%, what we're going to do is we're going to say, okay, I'm going to take that 20% and I'm going to double it. So I'm depreciating at 40% per year. So I'm going to take, so for the first year, I'm going to depreciate it by 2,400, which means my book value is going to be 3,600. So the next year, year 2, I have a book value of 3,600. I'm still taking that 40%. This year I'm taking 1,440, and this is my new book value. Okay. So still taking that 40%. Let's see if it'll copy. Yep. Okay. So that 600, that residual value comes into play right here. I cannot depreciate below my residual value, which means that I cannot take my full depreciation in year 5. What I have to do is I can only depreciate it to my residual value. So I can only depreciate it $177.60 so that I'm left with my residual value here. So year 1, this is our depreciation, 2, 3, 4, and 5. Okay, so that essentially is how you do your double declining method of depreciation.